This is Dr. Phil Rosenkrantz again. We're now in Chapter 12 about income taxes, where we're going to be talking about both corporate and personal income taxes. Let's take a look at our big picture again. We're now continuing on in the refining the analysis process. We've already talked about depreciation, so now that we know what depreciation is, we will incorporate it into our analysis so that we can calculate our taxes owed, then our after-tax cash flow, and finally our after-tax rate of return. It is important to understand income taxes because they affect our cash flow, our profit, and management decisions concerning what to do with our money. So it's real important that we know how the taxes are imposed and also how they affect are incorporated into our analysis techniques. Essentially, government entities of all types are partners in your business. They have different taxes that they impose based on what their budgets and needs are and what legislative bodies have been able to approve. So you have income taxes based on earnings of the company, property taxes based on the property values of the property that you have, sales taxes, and also use taxes of various types. And these are collected by federal, state, county, and city entities. In this analysis, we're only looking at federal income tax. So it gives you an idea of how to make the calculations. But depending on where you live, what state, for example, uh, then taxes can change. So we're just going to stick with federal income tax for this presentation, just so you get the basic idea. So our general process is to first of all understand the tax laws that affect the project of interest. In other words, what the appropriate depreciation method is, what we can depreciate. Then we need to estimate our cash flows, first of all, without considering the effects of taxes. Then make adjustments to those cash flows based on the effects of depreciation and income taxes, and then using the appropriate Excel function or whatever method we want, determine our final measures such as net present worth, payback period, rate of return, etc. So now we're going to calculate our taxable income. The tax accountants within the company will determine the appropriate depreciation method to use, what is depreciable, but we need to consider that taxes are just another cost of doing business, but we want to use the most favorable method in order to maximize our profit and our cash flow. Let's review for a moment something we talked about at the beginning of the course, which was the accounting lecture. We talked about two kinds of expenses. These are tangible expenses. The capital expenses are items that last more than 1 year, so we have to figure out how to spread those expenses out over time. We're talking about depreciable assets that are things like equipment and buildings and things like that. We're not talking about non-depreciable assets such as land. Keep in mind, operating expenses are things that are used up in less than a year, so we will be deducting them as expenses against the profit that we are making. Need to make some comments about income tax rates. Keep in mind that as needs of the country or the county or the state change, and as we get different administrations, then tax rates change quite rapidly. In fact, the current edition of the book reflects some major changes in the last 2 years in tax rates. So we will use the book tax rates to do our homework and lectures for this course, but keep in mind that even those have changed already. You can go online and various places find the current tax rates. We need to talk about the taxing of capital gains and losses for a second. It used to be that the government would create an incentive for people to invest. That could be either investing in equipment if you're a company, or investing in property or stocks and bonds if you were an individual. And in order to create an incentive, they would have a lower tax rate on anything that you kept for more than a year. And so if you sold something for a profit, that was a capital gain and it was taxed at a lower rate than your ordinary income taxes. And if you had a loss, you could also benefit from that against your other investments. But sometimes they change the capital gains tax rate to be equal to the ordinary income tax rate. And that's what's going on right now. But that could change at any time. So just something to be aware of, that when you have salvage value, that's something you've kept for more than a year. So its tax rate may be different than the ordinary tax rate for that year. So now we're ready to calculate our after-tax cash flow and our after-tax net present worth and rate of return. So we start with our before-tax cash flows that we've developed in prior chapters. Now we have to subtract from that the depreciation expense to find our taxable income. Then, from knowing our taxable income, compute the income taxes owed. Now subtract the income taxes owed from our before tax cash flow to get the after tax cash flow. And using the after tax cash flow, we can now calculate rate of return, payback period, net present worth, whatever we want. One of the biggest changes in this textbook edition has been regarding corporate income tax rates. A couple of years ago, with new Congress, new administration, they made a humongous change in tax rates. We used to have a progressive income tax system, which you can see under the 2017 tax rate column, where the tax rate started out at 15%, jumped up to 39%, and then leveled off eventually at 35%. So pretty much any company in business is going to probably be over the $100,000 or over the $75,000 category. So we're paying 34% or more of their taxable income in taxes. So the current laws are 21% for everyone. Now, you'll notice that that's quite a drop in the income tax rate. And what that does is, first of all, it increases the profitability for a company, and that allows them to invest more in stimulating their own company operations, and also in lowering prices, being more competitive. They can also hire more people. So it stimulates the economy. But another interesting feature of having a 21% tax rate is that it allows companies that have moved operations away from the United States to other countries that have lower tax rates. It gives them an incentive to now bring their operations back to the shores of the United States, because now they could get a lower tax rate here in the United States. So this particular tax rate was designed to stimulate the economy and to bring um, work back to the United States. Keep in mind that as a company makes more profit and their stock value goes up, those of us that have money invested in those companies through mutual funds in our 401ks and IRAs benefit. So, just something to keep in mind when you're looking at these tax rates, the impact of what they have on our economy. Now we're going to use data from example 12.6 to calculate the net present worth and rate of return four different ways. This gives us a chance to look at uh, different types of depreciation and also compare that to our before tax rate of return. Let me point out that bonus depreciation is an incentive that the government gives for companies to invest in certain categories of equipment to stimulate the economy. They allow them to subtract almost all the depreciation very early, as opposed to stringing it out over the life of the product. So our first calculations of rate of return and net present worth are going to be using our before tax cash flows. You've seen this before. We have a $25,000 investment. We get a net benefit after income minus expenses of $8,000 a year for 5 years, and then we sell the equipment for $6,000, our salvage value, at the end of the fifth year. And so if we just look at these before tax cash flows and calculate the net present worth and the um, rate of return, we see we have a present worth of benefits of 29,800, subtract our 25,000 present worth of cost for the initial investment, have a net present worth or net present value of 4,800 and an internal rate of return of 22.6%. So this is our base, and it doesn't take into account depreciation or taxes. Now, it does mention that we have a minimum attractive rate of return of 15%. In other words, this would be our cutoff. Anything below 15% would be undesirable. And you can see the 22.2% is well above that. So this is a before tax minimum attractive rate of return. Next, we're going to be calculating after tax rate of return, and a company will typically have an after tax minimum attractive rate of return that they use for those situations. Now the fun begins. We finally get to calculate an after tax cash flow and also our after tax rate of return. This is a little more complicated. This seems to give students a little bit of trouble, so you need to spend some time to understand what's going on. So we have our before tax cash flow in the left column. So this is what we dealt with prior. Now we have to make some adjustments to it. Now our first example is where we are going to take the entire $25,000 depreciation as bonus depreciation in year one. So we're not going to spread it out over the 5 years. We're going to take it all up in year one. The government's allowing us to do that. This is an incentive. But by taking that depreciation early, we show a taxable income that is actually negative. We had an $8,000 benefit for the year. We're subtracting 25,000 depreciation. It shows a loss in year one of this project of minus 17,000. Now let's discuss that for a second. This is a project that is being done within the context of a large profitable corporation. So this minus 17,000, this loss helps offset $17,000 of profit from some other part of the business. So it shields us from taxes on $17,000 and increases our profit by the amount of taxes that we avoided, which was 21% of that. So we are actually getting a $3,570 benefit by depreciating so much in year one. So if we take our before tax cash flow of 8,000, our tax savings of 3570, we have a resulting after tax cash flow in year one of 11,570. Then for the next 3 years, we basically have the same cash flow, our $8,000 before tax cash flow minus our taxes of 1680. So we have a positive cash flow of 6,320. That also applies in year five, by the way. Our $6,000 salvage value, because it's $6,000 over the book value, we have to pay ordinary income taxes on that minus 1260. So our positive cash flow is 4,740. Let me get back to that book value comment for a moment. Our book value was zero because we depreciated the entire amount of the investment. So 25,000 invested minus 25,000 depreciated means we had a zero book value. So selling it for 6,000 as salvage value, that 6,000 was a profit on the sale, a capital gain, taxed at ordinary income tax rates. So anyway, this is our first example. On the next slide, we are going to take a look at the actual rate of return. Here we have the calculations for net present worth using the minimum attractive rate of return of 15%. Now, this is the same as the before tax minimum attractive rate of return, and in the book it mentions they used the same MARR for both before tax and after tax purposes, but that's just to show the impact of the depreciation on taxes and on rate of return. But anyway, the rate of return is now 20.34%. Example 12.7 in the book uses the same before tax cash flow as 12.6. But here we're entitled to take a 40% bonus depreciation in year one and then use MACRS depreciation to depreciate the remaining $15,000 over a 5-year period. So in the first year, the depreciation expense is shown as 40% of the 25,000. So that gets us $10,000. And then the MACRS maker's first year depreciation is 20%. So 20% of 15,000 that's remaining is 3,000. So 10,000 plus 3,000 is $13,000 of depreciation. And so again, like in the previous example, in year one we had a loss in the taxable income column, which produced a savings in taxes of 1,050. So our first year after tax cash flow is 8,000 plus 1,050 or 9,050. So if we go ahead and calculate our after tax cash flow for this, and I'm pointing out here that there is a in year five they treated the depreciation a little different, but anyway, now we have a new after tax cash flow, and on the next slide we'll look at the rate of return. So using our Excel functions, we find the internal rate of return here of 19.1%. Our fourth example is example 12.8 in the book using the same data, but the $25,000 bonus depreciation we are allowed to actually take in year zero. And so let's see what that does to our after-tax cash flow. There was no before-tax benefit at year zero because it hadn't happened yet, but we still get to subtract the $25,000 depreciation at the very beginning. So it gives us a tax savings of 5,250 in year zero and an after-tax cash flow then of minus 19,750. And you can see what the rest of the after-tax cash flows are. And now let's take a look and see what the effect is on our rate of return. So the rate of return on the example with all of the bonus depreciation taken in year zero is 22.2%. And on the next slide, we will look at a summary of all four different treatments. Our first case did not pay any taxes, so we had a higher income. So it's no surprise that the rate of return is the highest there, 22.2%. In the second case, we took our bonus depreciation in year one. So even though we had to pay taxes, we did get to make a huge deduction early in the cash flows. And money in our favor earlier is better than money later. So it only cost us almost 2% in our rate of return. Our third case, we didn't get to take all the bonus depreciation very early. In fact, we had some depreciation in year five. So that lowered our rate of return because we didn't have the money in our hands. That lowered it to 19.1%. But in the last case, by taking all the depreciation at year zero, we basically returned to the before tax rate of return series of cash flows. So we got a 22.2% rate of return. So you can see that depreciation, the sooner we can take it, then the more cash flow and the better the rate of return. Our last 6 slides are going to deal with personal income taxes. So basically with personal income tax, what we do is we start out with our gross income, which is all of the earnings we have through wages, tips, interest that's taxable, any dividends from stocks, capital gains from sale of our property, and any other income. We start with that. Then we subtract away adjustments for things like our deferred investments, deferred income, such as from a 401k or an IRA, and that gives us our adjusted gross income. Now, up until the last year or two, at this point, we could subtract exemptions for the number of people in our family, a certain amount of money. But under the new tax laws, we don't have those exemptions anymore. What we do have are larger standard deductions, and we also have lower tax rates that kind of compensated for that. So now we have our adjusted gross income, and we can subtract either the standard deduction or itemized deductions, whichever is the largest. So the standard deduction for a single person is $12,000, and it's $24,000 for a married couple. So that would be what we would compare to um, what our total of itemized deductions would be. So itemized deductions are things like donations to charitable organizations, some of the taxes we paid, like state taxes, interest on your home, which is a big one for many people, major medical expenses, those would be uh, if you have really huge medical expenses, you can deduct some of it. And so you have to add up your itemized deductions and then compare that to the standard deduction to determine which is more. So after you pick which one it is, you subtract the deductions from the adjusted gross income and get your taxable income. Then you go to the tax tables to determine how much you owe. The income tax rate that you have to pay is based on your status. And the first one we're going to look at is if you are a single person paying taxes, you're not married. And the tax percentage you pay for income of a taxable income of under 95.25 is 10%. Then we have brackets after that. Let's look at the next bracket. If your taxable income is between 95.26 and 38,700, you pay $952.50 plus 12% of everything over 95.25. So this is the 12% tax bracket, and you are paying a marginal amount on every additional dollar you earn of 12%. Now, once you hit the top of the bracket, you go into the next bracket. And so you can see there, uh, for for example, if you're single and you're making under 157,050, then you're making 24%. You're paying 24% or less on each dollar that you earn. So anyway, that's the single tax bracket uh, picture, and you can see that if you're let's look at if you make over a $500,000 a year of taxable income, you're in the 37% tax bracket. Now let's look at the next most common uh, tax table, and that's for married filing jointly. And you can see that the numbers are different because you're combining two incomes. But basically, the table works the same. There's a note at the bottom of the table points out that there are two more tables available. I don't think they're even in your book. There's head of household and married filing separately, and those would be less common than the other two. But these are the tax tables that we're working with. We're going to finish up this presentation with three examples. First example is a single student. This is simple. Gross income of 15,000, probably reflects part-time work. So there's no 401ks or anything here. Adjusted gross income 15,000. The standard deduction would make the most sense for this person, and so their taxable income is 3,000, and 10% of that from the chart is $300. So that's not very much. People with low incomes pay very low federal taxes. Note that the book does discuss um, some tuition tax credit type opportunities, and probably if this was a student, they would probably end up not paying anything in taxes. Now let's dramatize the impact of making more money. So let's talk about a young single engineer making $70,000, and let's suppose they're putting 10% of their gross salary into a 401k. So that's $7,000 that can be subtracted from their gross income to get the adjusted gross income. And suppose they don't have enough itemized deductions to break the $12,000 barrier. So they're going to take the standard deduction of 12,000. That now brings their taxable income down to 51,000. And using the tax table, the taxes are shown there as 4,453.50 plus 22% of everything above 38,700, and that comes out to $7,159.50 of federal taxes, or almost $600 a month. Now that's quite a bit more than when the student was making a small $15,000 salary. So when you go to work, you might want to, for that first year of that big income, you might want to make sure that you're having enough withholding taken out of your paycheck so that you aren't clobbered with a large uh, taxes owed at the end of the year. And by the way, you're supposed to be within a certain percentage of what you owe to avoid any penalties. So anyway, this is the calculation again with a standard deduction example. Finally, we're at our last slide. Now our young single engineer is buying a condo. Suppose it's $300,000, 20% down payment. So their mortgage, their loan is going to be for $240,000, and let's say it's a 30-year loan and at 5%. The monthly payments will be $1,234, and the interest for the first year from all those payments is going to be 11,783. So that's that interest is tax deductible. Suppose they're paying $6,000 a year in property taxes and making charitable donations of $3,000. And this example doesn't even include, for example, if you're in California, you would be paying some state taxes that would be deductible for federal purposes. But anyway, our itemized total here is 20,783. So we subtract that from our other taxable income to get a new taxable income of 42,217, a total taxes owed of 5,227.50, and just for comparison purposes, that's $1,932 less than the previous year. So the tax savings or the by buying the condo is almost $2,000 a year. Keep in mind you may be paying a lot more in other ways because you paid taxes, etc., property taxes. But just wanted to show that for comparison purposes. Not going to put another example with, say, married couple filing jointly, but that'll be taken care of in the homework assignment. So anyway, this was kind of a long presentation, but it covered an awful lot of material, and you really need to pay attention to it for both professional and personal reasons.